EP21, Bitcoin Change Outputs Explained. Why your wallet sends money back to you. Here's the beginner moment that makes Bitcoin feel broken. You send Bitcoin to someone, you check the transaction, and there are two outputs. One goes to the person you paid, the other goes to an address you do not recognize. For a second, your stomach drops. Did I send too much? Did somebody steal the rest? Why did my wallet create a mystery address? That mystery address is usually not a thief. It is usually change. And if you understand change outputs, a lot of Bitcoin suddenly makes more sense. UTXOs, wallet balances, privacy, labels, fees, and why your transaction history sometimes looks stranger than your intent. Last episode, we talked about wallet labels. Your wallet can show you a balance, but it cannot remember your intent unless you write it down. This episode is the next layer. When a transaction has leftover value, where does it go? Let's start with the receipt. Bitcoin does not work like a checking account balance. It works with transaction outputs. A wallet balance is made of spendable pieces. Those pieces are UTXOs, unspent transaction outputs. If you have one UTXO worth 1 million sats and you want to pay someone 300,000 sats, the wallet does not shave off exactly 300,000 sats from the piece and leave the rest sitting there unchanged. The wallet spends the whole piece. Then the transaction creates outputs. One output pays the recipient, one output sends the leftover amount back to you as change, and the fee is the difference between what went in and what came out. So a simplified version looks like this. Input, 1 million sats. Payment output, 300,000 sats. Change output, 690,000 sats. Fee, 10,000 sats. That is the basic shape. The important part is that the change output is not a refund from someone else. It is not a second payment. It is not income. It is usually your own money coming back to your own wallet at a new address your wallet controls. That is why Bitcoin Core's documentation can identify whether an address was used for change. The wallet knows the internal bookkeeping. The chain by itself only shows outputs. The blockchain does not attach a friendly sticky note that says, this one is the merchant and this one is your change. Your wallet knows. Outside observers guess. And that gap matters. The first mistake beginners make is thinking a new address means a new person. Not necessarily. Bitcoin wallets often use new addresses for privacy. Bitcoin.org's privacy guidance tells users to use a new address for each payment they receive. The same general privacy idea applies to change. Many wallets send change to a fresh address controlled by the wallet instead of reusing an old one. That is why your history can look weird. You paid one person, but your transaction created two outputs. One of those outputs may be yours. This is not the wallet being dramatic. It is how the accounting model works. Second mistake, thinking change is optional. In practice, if the input you spend is larger than the payment plus fee, the leftover has to go somewhere. If it does not go to a change output, it becomes part of the transaction fee. That is not what you want. If you accidentally built a transaction that spent 1 million sats and only paid 300,000 sats with no change output, the missing 700,000 sats would not magically sit in your wallet. It would be interpreted as fee. Good wallets prevent that. They create change, they select inputs, they estimate fees, they send the leftover to an address they control. That is normal. Third mistake, thinking the wallet balance is one blob. This is where EP19 comes back. Your wallet balance is not a single pile. It is a collection of pieces. When you make a payment, the wallet chooses one or more pieces to spend. If the selected pieces add up to more than the payment, you get change. That is the simplest way to understand it. Imagine you buy a $5 coffee with a $20 bill. You do not tear off $5 of the bill. You hand over the whole 20 and get change back. Bitcoin is not paper cash, but the mental model helps. A UTXO is more like a bill than a bank account decimal. Spend the bill. Create outputs. Keep the change. Now here's the part that makes Bitcoin different from the cash example. With cash, the cashier hands the change back to you. You can see the action clearly. $5 goes to the store, $15 comes back to your hand. With Bitcoin, the wallet constructs one transaction. Inside that transaction, the payment output and the change output sit next to each other. They are both outputs. They are both visible on chain. They are both just scripts locking value to conditions. That is why block explorers can confuse beginners. A block explorer is not your wallet. It does not know your intent. It may label addresses, cluster activity, or guess at meaning, but it is still looking from the outside. Your wallet has the private context. It knows which address it generated internally. It knows which output was supposed to come back to you. So if a block explorer makes the transaction look weird, do not treat the explorer as the final authority on your personal records. Use your wallet, use your labels, use your own transaction notes, and if something still looks wrong, slow down before you send the next transaction. Fourth receipt, change can create privacy risk. Because the blockchain shows outputs, analysts try to guess which output is the recipient and which output is change. Sometimes they are wrong. Sometimes they are right. And when they are right, they can link pieces of wallet history together. That is why address reuse is such a common beginner mistake. If you reuse addresses, you make it easier for outside observers to connect activity. If your wallet creates a fresh change address, it is trying to avoid some of that linkage. But change can still leak clues depending on the amounts, address types, wallet behavior, and how the coins are later spent. This is not a reason to panic. It is a reason to respect the details. Bitcoin is public by design. Privacy is something you practice. Fifth receipt, change is why labels matter. A change output might belong to you. But months later, if you are staring at transaction history without context, it may look like a mysterious transfer. That is where wallet labels and records help. If you made a payment from cold storage to an exchange, label the event. If you consolidated UTXOs during low fees, label it. If a change output returned to your wallet after a specific payment, your wallet may know internally, but your external record should still preserve the story. The chain says what moved. Your records explain why. Sixth receipt, change matters for fees. Every output you create can become a future input. Future inputs take space in future transactions, and transaction size affects fees. So UTXO management is not just nerd trivia. If you create lots of tiny change outputs over time, you may create a mess that is more expensive to spend later when fees rise. If you consolidate at the wrong time or in the wrong way, you can also create privacy problems. There is no one-size-fits-all rule. A beginner does not need to obsess over every sat, but you should know the mechanism. Change outputs are not random. They shape your future wallet. This is also why coin control exists in more advanced wallets. Coin control lets a user choose which UTXOs to spend instead of letting the wallet pick automatically. That can matter for fees, privacy, and records. But coin control is also powerful enough to create confusion if you do not know what you are doing. For a beginner, the first job is not to become a wallet engineer. The first job is to understand the receipt. Inputs are the pieces being spent. Outputs are where the value goes. Change is the leftover value returning to your wallet. Fees are the difference. Once that shape is clear, the advanced features stop feeling like magic words. They become controls attached to a model you actually understand. Seventh receipt, change is not a taxable event by itself. This is where we stay careful. Moving your own leftover Bitcoin back to your own wallet, as change is generally not the same as selling Bitcoin or receiving income. But the larger transaction may still matter if it was a sale, spend, exchange, gift, or payment. So do not treat the change output as the tax event. Treat the whole transaction as the thing to understand. What did you pay? What did you receive? Did ownership change? Was there a disposal? Which UTXOs were spent? What evidence do you have? This is educational only, not tax advice. But the record-keeping principle is simple. Classify the event, not just the address. Here's the practical rule. When you see an unfamiliar output in your own transaction, do not panic. Ask 3 questions. Did my wallet create this as change? Does the wallet still control the address? Does my record explain the payment that created it? If the answer is yes, you are probably looking at normal Bitcoin mechanics. If the answer is no, slow down and investigate before making assumptions. Good wallets abstract most of this away. That is helpful, but abstraction has a cost. If you never learn what is underneath, the first confusing transaction can scare you into thinking something went wrong. Bitcoin did not go wrong. It just did accounting in a way your bank app never had to show you. That visibility is part of the bargain. In the bank world, the institution hides the plumbing. You see a clean balance. The bank sees the ledger, The bank can reverse, freeze, categorize, explain, and intermediate. In Bitcoin, you get direct settlement, but direct settlement means you are closer to the machinery. You see inputs, you see outputs, you see fees, you see addresses. Sometimes you see the raw skeleton of money movement and mistake it for a problem. It is not a problem. It is a responsibility. Self-custody means the receipt drawer is yours. That is the whole point of this record series. UTXOs are the pieces. Labels are the memory. Change outputs are the leftovers coming home. Records are how future you knows the difference between a payment, a transfer, a consolidation, and a normal change return. So next time you send Bitcoin and see two outputs, remember the receipt. One output may be the person you paid. One output may be you. The fee is what did not come back. And the record is what keeps the story straight. Next episode, we go from change outputs to coin selection. How wallets decide which pieces of Bitcoin to spend in the first place, and why that choice can affect fees, privacy, and your future records. This is Exit Velocity. Think in Bitcoin. Educational only. This is not financial, tax, or legal advice.